All right, let's jump right into this explainer and unravel a pretty fascinating financial mystery hidden right inside the Verisk Analytics Q 2026 earnings report. Now, if you follow corporate finance or just love seeing how massive global companies navigate multi-billion-dollar shockwaves, you are absolutely in for a treat today. We're going to look at a classic corporate paradox, a situation where the headline numbers tell one story, but the underlying gears of the business tell something entirely different and, frankly, much more dramatic. So let's start straight at the top line. For the second quarter of 2026, Verisk brought in a massive $806.3 million in revenue. I mean, just let that number sink in for a second. Over $800 million in a single 3-month period. And what's even more impressive is that this is a really solid increase from the previous year, where they pulled in $772.6 million for the same quarter. On the surface, you've got a company whose growth engine is firing on absolutely all cylinders, bringing more money through the front door than they did a year ago. But here's where we hit a wall, a real paradox. Despite that revenue going up, their net income for that exact same quarter, it was only $228.6 million. That is a significant drop from the $253.3 million they recorded in the second quarter of 2025. So the money coming in went up, but the profit left over at the very end of the day actually went down by nearly $25 million.
So we've got to ask ourselves a crucial question here. How exactly does a massively successful company grow its revenue but watch its net income shrink? In the corporate world, that's a giant red flag that demands immediate investigation. It usually means costs have suddenly spiked, a massive one-time event occurred, or the core business model is springing a leak. So, which one is it for Verisk?
Well, to answer that, we're going to put on our financial detective hats and go straight to the source material, their official Q2 2026 Form 10-Q, filed with the Securities and Exchange Commission. The answers to these billion-dollar questions are almost always buried deep within the footnotes and the dense financial tables of these regulatory filings. We've combed through this massive document to extract the exact data and footnotes you need to understand the whole story.
First up, Section 1, Unpacking the Revenue Engine.
Now, to understand the anomaly, we really need to understand their baseline first. Using their own words from the filing, Verisk is a strategic data analytics and technology partner to the global insurance industry. Basically, they sell the critical data that insurance companies absolutely rely on. Whether it's pricing risks, processing claims, assessing climate change impacts, or combating fraud, Verisk provides the advanced data analytics and scientific research to make it happen. They are quite literally the invisible nervous system of the insurance world.
When we actually break down that $806.3 million in Q2 revenue, the split is super clear. The vast majority, a staggering $569.1 million, comes directly from underwriting. That's the data used to decide who gets insured and for how much. And that's supported by another $237.2 million from claims, which is the data used when a disaster actually strikes and payouts need to happen. And the crazy thing? Both of these segments grew compared to 2025.
And if we break the numbers down geographically, their market dominance is heavily, and I mean heavily, concentrated in the United States. The U.S. generated over $650 million this quarter alone. The United Kingdom brought in $66.3 million, and all other countries combined accounted for just $88.7 million. So we firmly established that the core business is incredibly healthy, growing, and deeply entrenched in the U.S. insurance market. The shrinking net income, it is definitely not a revenue problem.
Which brings us to Section 2, the plot twist, the AccuLynx fallout.
All right, this is where we finally peel back the curtain and find our multi-million-dollar culprit. Buried deep in the debt notes of the 10-Q filing, there's this highly specific corporate finance term, special mandatory redemption. In plain English, this is a provision that forces a company to immediately pay back borrowed money if a specific event happens. In Verisk's case, they had issued massive amounts of debt, notes, specifically to fund the acquisition of a company called AccuLynx, but the deal was terminated. Because the acquisition failed, the special mandatory redemption was instantly triggered.
It's wild to think about how incredibly fast this whole thing played out. On December 26, 2025, literally the day after Christmas, the AccuLynx acquisition was officially terminated. Just 3 days later, on December 29th, Verisk had to notify their trustee that the trigger had been pulled. And by January 6, 2026, less than 2 weeks after the deal died, Verisk was forced to abruptly pay back $1.5 billion in debt.
Now, returning $1.5 billion is a logistical nightmare all on its own, right?
But it actually gets worse, and this directly answers our paradox. Because the deal fell through, Verisk didn't just have to return the $1.5 billion, which was split between $750 million in notes due in 2030 and another $750 million due in 2036. No, they were contractually obligated to pay a 101% special mandatory redemption price. That extra 1% acts as a brutal penalty premium, costing them a cool $15 million right out of pocket. Between that premium and the rapid write-off of issuance costs, Verisk recognized a total loss of $33.9 million related to this redemption. That sudden, massive expense is a primary reason why, despite making more revenue, their overall net income for the period took such a visible hit.
Moving right along to Section 3, massive debt and buybacks.
So we know where the debt went, and we've solved the mystery of the shrinking net income. But digging into the cash flow statement uncovers an even bigger surprise about how Verisk treats its shareholders. The contrast here is absolutely incredible. This is easily one of the most stunning data points in the entire 10Q. In the first 6 months of 2025, Verisk bought back a very respectable $300.1 million of their own stock. But in the first half of 2026, the exact same period where they had to suddenly cough up $1.5 billion for a failed acquisition, they somehow bought back an astronomical $1.57 billion in stock. They increased their share purchases by more than 5 times during a period of massive corporate turbulence.
So how is that mathematically possible? Well, they had to actively manage this massive cash movement, to refuel their reserves after that huge AccuLynx payout, and still fund these massive shareholder rewards. Verisk went right back to the debt markets. In February 2026, they issued $1 billion in new senior notes, $500 million due in 2031, and another $500 million due in 2036. They took the proceeds from this brand new debt and used it to repay their syndicated revolving credit facility and a term loan facility. Essentially, they brilliantly restructured their debt on the fly to ensure they maintain the ultimate corporate superpower, liquidity.
And you know, all that liquidity is backed up by raw, undeniable operational power. The numbers from their first half 2026 financial health check are wild. Despite the net income taking a hit on paper, bringing it down to $462.8 million for the 6-month period, their actual net cash from operating activities was a staggering $756.4 million. This is the pure cash their business generated from just doing what it does best, selling data. They ended the period with over $550 million in cash and cash equivalents still sitting safely in the bank. This data absolutely proves that the underlying engine is still roaring, completely unbothered by the turbulence of the debt restructuring.
And that leads us to our final section, the big takeaway.
Let's wrap up this explainer by putting all these intricate corporate puzzle pieces together. We've looked at the massive revenue, the failed acquisition, the debt triggers, and those staggering stock buybacks. I want to leave you with this one thought to take away. How resilient must a company be to absorb a sudden $1.5 billion debt redemption, pay millions in penalties, and still have the financial firepower to buy back over $1.5 billion of its own stock in just 6 months? The answer? Incredibly resilient. While the headline net income dipped and created our initial paradox, this SEC filing reveals that Verisk's underlying revenue engine is so insanely strong, it allowed them to effortlessly survive a multi-billion-dollar corporate shockwave, completely restructure their debt, and still deliver an absolute massive payday to their investors. Thanks for joining me on this deep dive into the numbers today. And hey, always keep your eyes peeled on those financial footnotes, because they always tell the real story.